Welcome back to another episode. You're with me, CJ Terra, with Zedsauce Forex Academy. Today we're discussing module 3 of our trading. So in this module, we're going to look at building a trading plan. Okay. So what is a trading plan? So a trading plan is like a roadmap. It guides your actions in the market to ensure you stay disciplined and consistent. Without a plan, you're more likely to make emotional decisions that can lead to losses. This module will teach you how to set goals, manage risk, and create a daily trading routine. Why is this needed? This is needed because it's a guide that you're going to follow religiously. It's like a recipe that you use to prepare something. The same goes with trading. You cannot just start your day minus following your plan. If you don't have a plan, trust me, you're going to find yourself losing a lot of money along the way. So the first thing that you're going to do is setting goals and what are your expectations. So before starting, ask yourself, why are you trading? What do you hope to achieve? These goals should be realistic, specific, and measurable. Okay, so for example, the short-term goal can be, I want to make 2% profits per week. This is achievable and helps build confidence as you grow. Avoid goals like I will double my account in a month, because those will cause you to overtrade and be a greedy person. Then the second is a long-term goal. Think about where you want to be in the next 1 or 2 years. For example, I want to grow my account to 50% over the next year. Long-term goals should focus on consistency and learning rather than only making money. Your goal in trading is not to only make money. You have to stay consistent. The money follows consistency, okay? It's not the other way around. If you're chasing the money, trust me, you won't stay long in the Forex game, okay? So the key tip here is write down your goals and review them regularly. Stay focused. Always remember to stay focused because that is what will guide you and keep you long standing along the way, okay? Second thing is creating a risk management strategy. Okay, you're gonna hear us talk about risk management because this is one of the most important things you can ever learn when it comes to trading. Okay, so risk management is about protecting your trading capital so you can trade another day. Even the best traders lose sometimes, but they manage their losses to avoid wiping out their account. Risk management is like this: you have a $10 or $100 in your account and you're like, okay, out of this $10 or $100, I'm only risking 1%. 1% of $100 is like a $10 or so, if I'm not wrong. Okay, so you're only risking a certain percentage out of that. It's like $1, sorry. So out of 100, you're only risking $1 per trade. Meaning, if the trade does not go in your favor, you only lose $1. Unlike those other people that are overconfident, say, I want to double this account. The same mentality that you have about doubling account is the same that can happen if you lose. Because if you're risking the entire account to make double, you might lose everything. Okay. So what is risk per trade? This is a common rule to risk no more than 1% of your account on a single trade. For example, if your account is 1,000, you should only risk $10 or $20 per trade. Okay, meaning if the trade does not go in your favor, you only lose a certain percentage. Okay, then there's what we call risk to reward ratio. Always aim for a reward that is at least 3 times your risk. For example, if you're risking $20 on a trade, your potential profit you should look out for is a $60. Okay. So in this way, you are guaranteed to say, even if you're losing more than you win, at the end of the day, you're going to end up a profitable trader. Okay. Then there's what we call stop losses and take profit. So a stop loss automatically closes a trade when it goes against you. Okay. Then a take profit also automatically closes the trade when it reaches in profit. So let's say you're risking a $10 out of your $1,000 account. You've placed what we call a stop loss. A stop loss ensures that the account does not go in negative up until your entire account is gone. So you say, I'm only risking $10 in this active trade. Meaning when that market reaches negative 10, that trade will automatically close. The same applies when the trade is in profit. When you are looking for a $60 profit out of that trade, when the market is in positive 60, it will automatically close for you. Okay. So, looking at developing a trading plan, what are some of the things that you want to look at when you are developing your trading plan? So, consistency is key in trading. A routine helps you focus and reduces stress by making trading decision more systematic. Okay, so the first things first, daily preparation. Okay, start by checking the economic calendar for major event. Remember, there's the fundamental side of trading. Okay, you look at that, how is it gonna affect, then review your charts to identify potential setup based on your strategy, and note down the currency pair you will focus on for the day. Don't just do changanya, like random things where you just boom boom, you're in the market, you don't exactly know why you are chosen that pair. Not like that. Then after trading, always review your trades. At the end of the day, ask yourself, did you follow your trading plan? What could I have done better next time? And keep a trading journal to track your performance and learn your mistakes. This I can never emphasize more, because when you are looking at the trades that you've taken and journaling them, it allows you to understand what mistakes you made and how you can adjust. Unlike when you just randomly trade without journaling, you will not know what mistake you made and how you can avoid that mistake. Then there's self-care and breaks. Set limits on trading, take regular breaks, and maintain a healthy lifestyle with proper sleep, exercise, and nutrition. After losses or wins, reset emotionally to avoid impulsive decision. It is very important that sometimes you might not win always, so you always have to understand those things. Okay, enough rest is important. Stay away from the market if you're not seeing any opportunities. Trading is addictive, yes, but you have to navigate your way around it. Then, during trading hours, you have to stick to your plan. Avoid impulsive trades. Monitor your trades, but avoid staring at the screen for too long. Okay, it's pointless. When you execute a trade, you have no power over it after that. You've put your stop loss, you've put your take profit. You looking at the charts will not change anything. It will not make the candles move any faster. It will not make the candles move any slower. Okay, you will not, just by staring at the charts, you will not intervene in any way. So it's best, once you take a trade, you walk away, you do some other things. Okay, adjust your stop loss and take profit only if the strategy calls for it. Okay, only if you've seen that the market maybe is consolidating, or if the market has gained a certain percentage and you want to move to break even or something, then you can adjust. Okay, then you have your weekly reflection and adjustments. At the end of the week, review your trades, analyze patterns, and identify mistakes. If you're gonna trade currencies during the weekend, definitely the market is gonna be closed. So this is the opportunity for you to take and look at the charts, analyze for the next week, and see what you're gonna do for the coming week. Okay. Then the last thing is networking and continuous learning. It is very important to be part of the trading community. I recommend you for being part of ours, because in this community, we're going to guide you through your very steps that you need to take as a trader. Okay, trading communities make you stay updated. They can even remind you when there's news, and you also learn new things every day. But that does not mean you should jump from one strategy to another. Always stick to your plan. Remember what we talked about. Always stick to your plan to ensure maximum success. Trading is a risky business. It's not always that you're gonna win, but your trading plan should prevail. If I asked you to cook a meal, you will never cook it the same all the time. It's gonna be different. Either it's gonna have a little bit more oil this time, a little bit of too much salt this time, this and that. Okay, but at the end of the day, the importance is a cooked meal. So the same applies with trading. It's not gonna have the same results every day, but as long as at the end of the day you have something to show for, to say this is my trades and this is how it has gone so far. Other than that, that's all I had for you on today's module. Always remember, a pip a day keeps poverty away, and stay safe in the streets.